Welcome to everyone. I just want to confirm everyone can hear me. Just let me know by saying in the chat box that you can hear me. Everything is fine, so that we can start with this afternoon's market overview. Just confirm for me that you can hear me by letting me know in the chat box. If everyone can do that, that would be good. Right. So I see there's a few more people coming in. Good afternoon and welcome. So this afternoon we're going to be focusing a little bit on the market overview of what happened in the past week or so and what's currently driving the driving forces behind what's happening on the market and the market conditions. So first of all, there's a few things that are having a major impact on how the markets are reacting to certain conditions and what we are seeing. If we're starting in the international side, I think it's very important to note that from the international side that we're seeing that the rand did start to strengthen against the dollar and all major currencies. Although we did see that Brexit did have a major impact on the markets and how people saw things happening and what they expect to happen in the near future. So let's give a little overview of everything. I want to talk a little bit about Brexit as well, just to give you some heads up and some factors about things that are going to happen going forward for South Africa and how that's going to impact you as an investor and also then how it's going to impact South Africa. So from the international side, we do see that markets are a little bit sluggish this year. Markets are struggling to pick up quite significantly. We don't see really a large amount of movement in the markets. Markets are really sluggish. With the S&P 500, one of our main indicators, the S&P 500 still running at 2,097 points last night, which it closed on. So the markets are still definitely below its all-time high at 2,132 points, and that's on the S&P 500. So that's one of the key levels that we are watching, which definitely has a major impact on how people are reacting. Due to the sluggish movement on the markets, we do see that investors are taking that negatively. We can see that people don't really want to keep their positions open anymore. So as soon as markets start getting up to the previous high points, we are seeing some sort of sell-off happening in the markets and people are getting out of their portfolio. So these are things that are not good. We do see from the international side still Brexit having. So the whole Brexit thing, just to talk about it, if there's anyone that has questions, you're more than welcome to ask questions during the session. You've got your chat box available, so please do interact if you have any questions in regards to the market. But just to give you an overview of what's happening. So first of all, we do see that Article 50 is playing a major role in the way that they need to handle Brexit and going forward in this regard. And we do note that so far they haven't received, the Euro Union hasn't received any form from Britain saying that, listen, we are getting out now officially and we are leaving you guys now. So we're still waiting for them to post that article and letting them know, listen, we are getting out and this is now final. So that's going to be one of the major things that you actually want to look forward to gauge, you know, in regards to the perceptions of what markets are thinking is going to happen. So the Brexit had an impact. So if we look a little bit at the Brexit, so we see that Britain needs to let the EU know that they're going to leave, and they need to do that by following Article 50 of the Lebanon Treaty that they need to call up. And that basically means, just to give you an overview of that treaty, basically means that every country that forms part of the European Union needs to let them know if they want to leave. If that country wants to leave the Euro Union, then they need to let them know, and it's based on their democratic right to leave as well, so there's nothing wrong with it. And they also need to let them know, because there's a slight chance with the news currently in the market about Britain leaving, there's a slight chance that there's also that Scotland wants to return and things like that. So then they're going to need to follow up, and that's going to be Article 49. So Article 50 goes, you can more welcome to go and Google that and read up about it. But the Article 50 is on leaving the Eurozone and the conditions on leaving the Eurozone, basically what's the implications thereon. If a country wants to join again the Euro Union, what Scotland's looking into doing, after they leave, they will probably get back into the European Union. They're going to need to follow Article 49. So there's a lot of things in regards to that. So investors did take that negatively. Once again, if I can point back to 2008, because this is a really main concern to us and to investors as well, but investors react really negatively to the slightest movement of market news that's out there, which is not always a good thing. Markets overreact to certain conditions, and the same goes to say with Brexit, which was an overreaction, I think, from investor side to the whole situation. People fearing that the relations between the Eurozone, the European Union, and then South Africa, that they're going to need to get new relationships going with the things that we import from them. But I think that's a little bit far-fetched, seeing that it does take about 2 years for us to, or for them to leave the Eurozone, Britain now. And also to take into consideration that most of our trade agreements that we do have in place, the news that's currently out there says that it doesn't seem that we're going to need to make new trade agreements so far unless something changes. So that's a good plus point. So although the Brexit thing happened, all of a sudden in the market there was a whole downwards negativity, people selling out of the market and fearing for the worst, and we did see the pullback, the rand hitting up again at 15 rand 57 against the dollar. And believe it or not, the evening previous, before the result came out of the Brexit, the rand was still trading. We looked at the rand up until about 11, 12 o'clock in the evening. The rand was trading at about 14 rand 30 against the dollar, which is significantly good. I mean, that's exactly what we want, is that rand to trade strong against the dollar. And also with lower oil prices, I'm going to talk about oil just now. So we had the rand trading strong, then all of a sudden the vote came in at about 2 o'clock, 3 o'clock in the morning, and then the rand all of a sudden just shot up to 15 rand 57 after the whole Brexit. So people do overreact to certain market conditions, and we know this is normal. We see this overreaction time and time again. After 2008, investors do tend to overreact to what is happening in the markets and the market conditions. So from an investor perspective, from share tracking, the way we try and teach our clients and how we move is that you need to take everything into consideration when you are doing a transaction and when you are looking at the markets. Don't just overreact on a certain condition. Go and determine what is actual implications going to be of this sort of movement on my portfolio, and does my shares that I currently hold in my portfolio, does it really have an effect on the companies that I currently own? Because it's not to say that the companies that you have in your portfolio is going to be affected by the whole Brexit effect and so forth. So an overreaction just based on what the rest of the market is doing is not correct. You need to do a normal technical and fundamental analysis based on the shares that you have in your portfolio before you just make a decision. So once again, we are busy with the international markets, and yes, the markets are sluggish. If you've been wondering, the news is out there, and we're seeing this in the market. The international data is showing a slowdown in most major economies. And the leading factor is the China economy, which is slowing down, and the slowdown of growth in the China economy. They went from a 7% GDP growth to the first quarter being 6.7%. So there's a 0.3% slowdown in GDP growth, and there's further expectancies of a slowdown to about 6% in GDP growth of the Chinese, which is not a good thing for the rest of the international markets. So what does that basically mean then for shares in this regard? So we do expect markets to continue to be sluggish from an international perspective. We did see that markets did make a high in the mid of 2015. If you remember that, we spoke about that quite often, that the markets did make its high in the mid of 2015 at about 2,032 points, and on the J203, which is the JSE All Share Index, it made a high at about 55,188 points, 55188. So if you like technical analysis, that's some figures that you probably want to write down. So on the S&P 500, it's going to be 2132. And then on the J203, which is the JSE All Share Index, is going to be 55188. Those are two figures that you want to look at, because that is one of the main reasons and things that we want to see if the market or the bull rally is going to continue. So far, markets are down. We are seeing bearish type trend going on, some sideways movements happening in some of the markets, but still, we do see some shares performing, and I'm going to talk about that a little bit later on as well. I just want to finish off with the international market. So the next thing in the international market is oil prices. So I hope everybody is aware of it, but fuel prices did go up. So if you're going to fill up your tank, it's going to cost you extra. If I remember correctly, you're looking at about a 41 cents increase in diesel prices and about 11 cents increase in normal petrol prices. So all of those are having an effect on the economy. Higher fuel prices means that companies are paying much more for transport, which means that food prices, the food inflation is probably going to start to increase as well. So all of this will continue to have a negative effect on the local economy. So based on what Brent crude is doing, so this is something that you need to look at. You cannot leave this out, is that Brent crude oil prices are currently trading at about $47.88 per barrel, which is good. It's sufficiently low. I think we tweeted about this a lot, but we're still saying that oil is trading in the region of about $45 to about $55 per barrel. We're not really expecting oil prices to go above $55 per barrel up until the end of this year. Maybe there might be some changes, and we might see, because of the supply getting hit, we see that there was an oversupply, but because of some problems in Nigeria and rebels attacking some of the oil plants over there, the supply levels are getting lower, so which means that prices for oil might start to go up a bit, but we do see oil still trading in the region of about $45 to $55 per barrel. Now the question is, a lot of people don't really know the reason behind why oil is trading in these levels. So the explanation behind it is, most of your oil producers in America produces oil at about $50 per barrel. So the average, or the amount for them to start making money off of it, is in the region of about $50. Anything more than that is good, but $50 is the benchmark. So that's why we do see that oil prices, the average price for a barrel of oil, will continue to trade in the region of about $50 per barrel. So I'm expecting it to stay in this region probably up until the end of this year, with the new greener efficiency, with Tesla bringing out new electrical cars. We do see in the next 5 years or so, up until 2020, we might see a turnaround because of electrical cars and Tesla pushing electrical cars. We might see oil prices dropping even more. We know that Bank of America has changed their estimates of the oil price to they're expecting oil to trade in the region of $15 per barrel, but that's not happening in the next year, but that is their forecast for oil going forward in the future. They did put it at $20 per barrel, but we did see a decrease happening from their statistics and from their estimates of oil, and we do see that they expect oil to be lower at about $15 per barrel, which is a good thing. If you're a South African, you would agree with me. We are currently paying a little bit much for fuel, over the 13 Rand mark for normal fuel and diesel as well. So you are going to feel it. One of these things, another thing that I've got some good news for you, is the fact that the Rand is trading much stronger against the dollar. We're in the region below 15 Rand against the dollar, which is good. And also fuel prices, Brent crude being lower. We might expect, once again, this is a big might, but from our estimates, we're expecting fuel prices to probably come down next month, if the Rand can continue to strengthen against the dollar and oil prices continues to trade below $50 per barrel. Unless that's going to happen, we're going to continue to see increases in fuel prices, unfortunately, because of the depreciating Rand and the stronger Brent crude price. On the local market side, looking at the markets and how markets are moving, we still see, although there's a lot of negativity in the markets, we do still see that there are shares which are performing. There are still shares that are making new highs and performing well. And most of the stocks that we've noticed is actually going to be the the commodity stocks. And that's because if you look at gold prices, we did see an increase in gold prices going up. And because of the increase in gold prices, we do see that a lot of the shares are benefiting from the stronger commodity prices. So DRD Gold, for instance, and Goldfields and sorry, not Goldfields, New Gold and Anglo Gold. All three of those benefited from the stronger gold prices. But now another thing, looking at the local markets, not only commodity stocks, if there's an increase in commodity stocks, that's a good thing, but we are seeing a slowdown in commodity prices going up, because most investors still feel that commodity prices are overpriced, which means that commodity prices might come down a little bit more. But because of the rand, which is so weak against most of the major currencies, most of the industrial companies which export raw materials are benefiting from a weaker rand. And that's why you see companies like DRD Gold paying a third dividend for this financial year. Because of the extra income or turnover that they're making from the weaker rand and higher commodity prices. Looking at the local economy, in today's newspaper, and this is why I got the business day open in front of me for all of you to see, the IMF has looked at their forecast for South Africa's GDP growth. They're expecting the GDP growth to go from 0.6% to only about 0.1% for this year, for 2016. Which is not a good thing. So basically what they are saying, that the GDP growth that we're expecting is going to be no growth at all. They're not really expecting any negativity, although, and I want to say this, and this is a concern that you need to look out for, is that first quarter results did show a decrease in production in materials and in the industrial side. So first quarter was negative. It was negative with 1.2%. So we had a negative 1.2% GDP growth, which means that we had a contraction. If we are going to see, if there's going to be, and I'm not saying that this is going to happen, but if the data is going to come in for the second quarter of 2016, and that data is also going to show a contraction, if it does show a contraction, we are officially going to be in a recession, because basic economics says to us that more than 2 contractions within a financial year basically means that the economy is then officially in a recession. But we're not there yet. We are seeing some positive movement in the industrial side, some positive data coming in on a month-to-month basis. So hopefully we're going to see some form of positivity in the second quarter. We know that the first quarter of every year is really sluggish, but hopefully we're going to see an increase going forward for the rest of this financial year. So in regards to how this will affect the markets, once again, you need to look at your portfolios from a strategic point of view. You cannot really just buy anything anymore. You need to be very precise in your technical and fundamental analysis. If you buy a share, make sure that the company that you're investing into, does it benefit from the weaker oil price, or from a stronger oil price, or from a weaker rand? So are you going to be looking at oil hedging shares or a rand hedging share? You know, those are some of the things that you want to focus on. And just to give you some feedback on rand hedging, we get this a lot. People want to know, what is rand hedge? So rand hedge basically means that this is a company that makes most of its profits, or most of its funds comes from overseas investments. So because of the weaker rand and the currency and the forex behind it, most of these companies that have which are regarded as rand hedge stocks, benefit from the weaker rand, which is a good thing. But once again, we do still see that some of the shares are performing. Once again, in today's business day, we did see Pick n Pay. Pick n Pay is picking up again. We did notice that Shoprite did put a lot of pressure on Pick n Pay, and they did take a lot of their market share. But we did see Pick n Pay going through a lot of changes in the company itself and in the structure of the company, and Pick n Pay share prices did pick up. They had very good financial results, and we do see their forecasts going forward looks much better. So shares like Pick n Pay are still picking up. And once again, commodity stocks like DRD Gold, Anglo Gold, they are still benefiting from the stronger gold price as well. I think one of the questions we get a lot as well is, do we expect gold prices to continue to go up? I don't know if there's anyone that has a question like that. Once again, you're more than welcome to ask me questions in regards to the market. Please do. But in regards to, do we expect gold prices to continue to go up? The question that you need to ask actually is not, is gold prices going to go up, but the question is going to be, are we expecting the stock market to continue to be weaker during 2016 going into 2017? Are you expecting more sluggish movement on the JSE itself and in the international markets? Are we expecting global economies to go into a recession? If we're going to answer yes on those questions, I think that we're going to see that gold prices might continue to go up. It's still above $1,300 for gold, so we might see it go up even more, seeing that we're coming from a level of about 1,100 in the previous, at the end of 2015 coming into this year. Gold is already up above $1,300. So these are things that you're going to need to look at and need to take into consideration. We do see that investors tend to buy commodity shares because of the high risks that they're currently experiencing because the markets are so sluggish. I once again want to put a lot of emphasis on this. If you've got a portfolio, make sure that you do make use of your stop losses. Make sure that you analyze your share technically and fundamentally. Go sit this afternoon, go and sit this weekend. Look at your portfolio, look at the way that your shares are currently trading. If you don't have stop losses in place, I want to advise actually that if you don't have stop losses in place, it's good to have risk measures in place should something happen on the market. 2008 has shown us that markets can turn around in a few weeks' time, and also markets has shown us with Brexit as well. Investors still react to the smallest news of negativity, and there is a lot of because of this negativity, a lot of emphasis is placed on it, and because of the fear in the market currently on the global economy and also the local economy, we do see that investors tend to overreact on their stocks, which is not a good thing. But once again, I think it's positive and negative. That's the negative side. I don't just want to be negative this afternoon, but because of the overreaction from some of the investors' side, a lot of investors are benefiting from it, because Warren Buffett states it like this: in a time of fear, that's when you should be greedy. Warren Buffett actually says that in this time of fear that you should actually be really greedy. And that's true to say. The reason behind that is because when there's a lot of fear in the markets, markets tend to pull back. And because markets pull back, it means that you can buy very, very good quality stocks trading up at dividend yields way above 5%. So please go and read the technical module lecture number 8 if you have not yet read it. Also, we just spoke about the dividend as well. A lot of the stocks are trading at very, very low dividends. Good quality shares trading at very low dividends. So I would advise that you do use the share filter to go and filter for those stocks that are trading at very high dividend yields. And remember, you do that by going to your website. If you log into the system, right, and you go to your share filter, I want to show you this afternoon because it's really important that you do make use of this. If you log into the system and you go to your share filter, which is located under subscribers, so we want to work with high quality stocks. So you can actually on the system use the top 40 list, or you're more than welcome to use the winning shares list. Just always remember, share tracking provides you with a winning shares list. We watch the markets as well. We set up a winning shares list which consists out of no more than 100 stocks. So you're more than welcome to use the winning shares as well. But if you only want to focus on high quality blue chip shares, then you can go to the share filter tool. You can click on the top 40. If you click on top 40, it will open up the filter for you in regards to this. And remember, in the middle you've got your dividend yield. And what you want to be looking for is for shares which are trading in the region of a 5% dividend yield or more. So out of the whole top 40 list, these are the only shares currently trading at or above 4% dividend yield, but which is on the region of a 5% dividend yield. And in our lecture modules, we say that we are searching for high quality shares that are for some odd reason are out of favor with the major institutions. One key thing that I want to say to you is that you need to make sure that when you buy a share that the trend is correct. Please watch out for bear trends. A lot of people think that it's easy to buy into a bear trend. Remember, when something moves negative downwards, we are not traders, we are investors, unless you are a trader. But as an investor, you want to get into a share, and when you analyze a share, that is in a bull trend, meaning positive upwards motion. How do you know when a stock is in a positive upwards motion? It's simple. You add your 200-day moving average to the share, 200-day simple moving average, and that will give you an indication of what the underlying trend is within the stock. Now, I want to end off with this for this afternoon session. A lot of people want to know what's going to happen locally. We do know that the elections are coming up, and the elections will have some sort of effect on the markets a little bit, I think, depending on what we expect to happen to the new parties that may be coming in between the ANC, EFF, and DA to see what's going to happen between them. So these things are going to have an impact on the markets. I think it's going to be a little bit, not that much, but nonetheless, it's going to have an effect on the markets. We do note that. So closer to the 3rd of August, you can expect much more volatility on the markets, I think, personally. So do watch the markets when you do your analysis of the shares. Another question we get a lot is what is going to happen to inflation. Remember, the Reserve Bank is trying to keep the inflation between the bands of 3 to 6%. It's currently trading above 6% on the inflation rate, which is not good. We want to get it below 6%, but the Reserve Bank is working hard to do that. And one way they do that is by increasing interest rates. So for those of you that know this, interest rates will continue to go up. I think if the rand continues to weaken, you need to understand this afternoon, that if the rand continues to weaken, which means that there's a heavy outflow of capital out of South Africa, in order to decrease, they cannot stop it, but they can decrease the amount of capital leaving South Africa. One way the Reserve Bank does that is by increasing interest rates. A better interest rate in South Africa is much more attractive for overseas investment. And because of our current account deficit that is so wide, that is a major problem. And one contributing factor to that deficit that South Africa is experiencing in the economy is because that we are currently exporting less than what we are importing. Now, this is just extra information, but you need to know this from investor side. So because we are exporting less, we do see the account deficit increase. So these are things that you want to look at, because we can expect that. Remember, we came from the credit rating agencies, which left our credit rating unchanged. But unless South Africa is going to get something in place and we're going to see a turnaround in the economy, and for them to place policies in place, I don't think that we can expect any sort of movement really to happen in 6 months. It's impossible to turn around a weak economy in 6 months and make something out of it. So 6 months is a short period, but what we do expect is that the Reserve Bank, Pravin Gordhan, is going to place more policies in place to make sure that we're going to see growth. And we do know that the unemployment rate is up to 26.7%, which is not good at all. So they're going to try and curb the unemployment rate as well. So these are things that we want to watch, data that we're seeing coming in. We are going to watch it closely, because this is going to give us an indication of what we're going to expect to happen at the end of the year, whether or not Fitch and Moody's and S&Ps are going to downgrade us even more because of the weaker economical data. And if that's going to happen, you can expect that markets are definitely going to react to that negative news, because it's not good if we go to below investment grade. It just basically means that South Africa is going to pay much, much higher percentages on the new loans that they're taking out. So once again, thank you very much for this afternoon, for this market recap. I hope you got something from it, and that's the news that we had that happened in the past week or so. It's important that you read up on the news. If you have any questions, please phone us on 012-940-0800. Should you have anything else, please let us know at support as well. so that we can assist you. Please remember to register for the latest webinars. Go to the stock market courses calendar to register for the new webinars coming up next week. See you soon. Thank you very much for everything, and enjoy your weekend. Bye-bye.